Peter Rose, Longwood Currency Trading. I just made a quick $3,000 scalping the pound, and I thought I'd share that with you because there's some differences. I don't usually scalp. I'm a day trader, and scalping is a whole different animal. So let's talk about that. But I thought I better take the Bo dog out for his walk, so we're gonna go do that. I gotta get him. Bo, wanna go out? There he is. Okay, let's go out. All right. I was just out here filming the other day, and as you can see, the leaves are really starting to come down. Okay, Bo. So, when there's a lot of volatility in the market, you can either push back from the desk and not trade that, which is generally the safe thing to do, or if there's reason behind the volatility, then there are ways that you can go about successfully trading in a highly volatile market. And I'm filming this on October 20th, 2022. I won't be posting it until a week later. Well, if you look at the news about the pound on the 20th, the British Prime Minister resigned, Theresa, and just after being in office for a little while, because she screwed up the whole thing. The economy is in the pits and everything went to shit. So I get up this morning and I'm looking at the chart, and I trade pound dollar. So the pound is just going crazy. It's going up like crazy. I mean, we're talking 15-minute bars that are 30, 40 pips. And they're usually like 7 or 8. What the hell is going on? So I checked the news feeds, and that's the thing. And they say that it was discounted, that her resigning had been talked about, and it was already discounted in the market. Well, somebody didn't tell somebody about that, because everybody's running around trading like a bunch of gerbils. I'm telling you, it was just crazy. You get in these panic situations where, I don't know whether it's the retail traders going crazy or the institutional traders just woke up and go, holy shit, I better unload these orders and build up my pound position, because I'm going to have to sell that off and buy dollars, because dollars is a safe haven at this particular time during all this crisis and crap that's going on. I don't trade by the news. I don't look at anything except the little squiggles on the chart. I'm a price action trader. That's it. I don't use indicators or any of that voodoo shit. It's meaningless to me. I've got a bachelor's degree in physics, almost a minor in math. I was a senior software engineer for 33 years and a real estate investor for 40 years. And I think Fibonacci's and Elliott Wave and all stochastics and all that, they're all just horse shit. I trade the real deal. I trade price action. And when you get a high volatility situation like this, you have to look at the underlying reasons. You have to take time to look at the underlying reasons. And if you can, a lot of the times what happens when you end up in a volatile price action situation is that there's some news out there that something could happen. War could break out. There's a hurricane coming, whatever it is. Hey, Bo. Oh, man. Hey, come on. God. There he goes. He doesn't want to, again, he doesn't want to walk with me, because Sue is off with a friend of hers. They went up to Meredith, New Hampshire to spend the day, having a great time. It's her friend's birthday, and so off they've gone to Meredith for the day. I'm here with the Bo dog, and we're walking the Bo dog through the woods. So you can have volatility caused because people think that something's going to happen, and you don't trade that. I could go in and, I mean, I've got that's part of what I do in consulting, and I go into this stuff. I could talk for 2 hours on this stuff. I don't want to bore you with it, but if it's if the volatility is a reaction to news that's about something that may, should, or could happen, you don't trade it. You don't get involved in it. It's like non-farm payroll. People get in there and they trade that crap because of what they think it's going to do. They're putting bets on either side, and when one side of it is wrong, there's a cluster shit and you get caught in it. That's why I don't trade non-farm payroll. I mean, sometimes I do just for the shit of it, because there's been so much pre-hype about it that it's pretty clear what the big players are going to have to do, and it'll settle down and you can do it. However, when you see that the volatility is being caused by news that's already been released, and it isn't just like a non-farm payroll or something, it has to be something relatively significant, not necessarily a surprise. I think the resignation of the PM was postulated, but as far as the general public, who would actually suspect a resignation from a major political leader? And so when that news came out, you just had these huge spikes in the pound dollar. And I'm thinking, well, wait a minute now. The dollar's doing pretty good because the Fed is aggressively dealing with the inflation that's running rampant around us. The UK is not doing good. They can raise their rates all they want, but they're in deep trouble right now for a whole bunch of reasons, politically as well as economically. And that isn't going to settle down anytime soon. Will it settle down? Yeah, oh, sure, it'll settle down. But right now, today, there's chaos in the market. You know, in the movie Crimson Tide, the captain said the best time to run a drill is when there's panic. You have to train to deal in panic situations. And so the experienced traders, and I am experienced, I've been doing this stuff since 2007, are able to swing over here so the sun isn't shining into the camera, Peter. Good move. And so I have a little better sense of what's going on. I'm not recommending anybody become a scalper or even do scalping unless you're doing it with a mini account and you're just trying to have fun. Because you have to have volatility in order to scalp. You got to have that market moving up and down all over the place. You place your bet from a probabilistic standpoint and your knowledge of the psychology of the players in the market, and over 10 or 20 trades you come out ahead. That's just the name of the game. If you're trying to day trade during a high volatile situation, whether it's anticipated or it's not, is crazy. Because if you get on the wrong side of that, are you gonna take your short stop, even if you have a reasonable stop out at 20 pips or something, and that gets hit? Are you going to have the discipline to say, okay, I hit my 20 pip stop, I'm done for the day? Or are you going to say, oh, no, I'm going to take another run at this? Well, as retail traders, that's what we're going to do. As bank traders, that's what they do. But they have unlimited resources in order to manage their money differently than as retail traders have. I mean, we may have $20,000 or $30,000, which is a lot of money. We may be trading with a couple of $100,000 or $300,000, and that's a shithouse full of money. But it isn't anything like what the bank traders have. And so anybody that tells you they're a bank trader and they're going to teach you how to be a retail trader is full of shit, and I wouldn't pay any attention to them. If you're experienced enough and you understand that the news that's causing this to happen, or whatever it is that's causing it to happen, has to have a release. It has to be a release. I'm watching price go up. Oh man, it had to be 80, 90, 100 pips in a very short period of time. I said, oh man, I'm gonna, because I'm expecting it to retract. I've got this 15-minute bar that looks like this, a 1-minute bar, or I mean an hour bar that looks like this. It's crazy. It has to come back. At some point, it has to come back. Now, you could call it a regression to the mean. You could put all kinds of fancy fibs on it. You do all the shit that you want to do. But the long and the short of understanding this and having the grapes and confidence to be able to go in and actually do something about it. Hey, Bo, we're going to go this way. Bo, hey, Bo. Rolling around the leaves. Hey, come on, come on. The only way you're going to have the grapes and confidence to trade this sort of thing is if you understand the principle behind the currency market. It's a zero-sum game. That means that for every winner, there's a loser. Not every game is zero-sum. The stock market is not zero-sum. There's a reason for that. I'm not going to get into all this stuff. You want to do this, take some consulting from me, and we'll go from there. But because the currency market is a zero-sum game, for every winner, there's going to be a loser. That means that all these people that are acting like crazy gerbils, pumping this stuff up and buying it, the institutional investors say, holy crap, the people have gone crazy. Let's get in this. Let's buy it. Meaning they're going to sell the dollar and buy the pound. Why? Because they want to sell the pound later and buy the dollar when it's cheap. This is just basic economics, and it's using the fact that 50% of the people that are in this trade that are causing this thing to go up, 50% of them are wrong. So when you finally get to the point where everybody's saying, well, wait a minute, how far is this thing going to go? Maybe I better not buy anymore. The institutional traders say, okay, goodbye, and they flush it out. And that's the play that I made. And in about, oh, come on. And it took me about 10 minutes to make 3,000 bucks. $2,500. Because I caught that. It was a couple of trades. They're very quick. Boom, boom, about 10, 15 minutes. I had to wait about 25 or 30 minutes for this thing to get blown off. And I had to take a couple of preliminary trades just to test the market to see if it was ready to come back down. But it just kept going up. You know, I'd lose $100, I'd lose a couple of $100. And I said, well, it shouldn't be going up. Well, it shouldn't have been going up in the first place, but it shouldn't be going up any further than where it was. But it was continuing to go up. And I just said, okay, I'm just going to sit on the sidelines and wait. I was down about $300 or $400 or $500, something like that. And finally, you began to see the break. Now, not to scare the shit out of anybody, but I'm down on the 5-second chart because I'm watching this stuff. Because what happens on the 5-second chart over a period of bars will become a 1-minute chart, which will become a 15-minute chart, which will become added into an hourly or daily chart. So I'm watching this thing as carefully as I can. When the opportunity presented itself and the momentum of the price action, which is different than the volatility, presented itself to me in a certain way, I backed up the truck and I went in deep and heavy. No guts, no glory. You go big when you have conviction and you make out big. Price went, and I made I don't know, $3,600. No, it was I made 25 on that trade, so I made about $2,900, which made up for the $300 or $400 that I had lost exchanging this stuff, and left me with about $2,500 profit. The whole trade took 10 minutes, but the lead up to it, while I was waiting for the price to resolve itself against this enormous rubber band that had been stretched way up, you knew that thing is going to have to snap. And so it snapped, but I didn't go in until that thing had come down sufficiently to the point where I could see that a lot of stops are going to get hit right here. Not some of the stops, but a lot of them. And I went in, and it just went like shit through a goose. It really did. It's a wonderful thing. $2,500 I'm up. Got another cup of coffee. Went back to the desk, and the stupid frickin' price is going back up again. What is wrong with these people? It went back up. Well, I tell you what was wrong with them is it finally got down a little bit further, because I got out before the thing stopped going down. I had $2,900. Man, I'm out, because I have certain rules, certain criteria that say, oh, okay, this is a real good percentage return for the risk that I've taken. Why lose that from a dollar value standpoint to try to press it? What are you going to try to do? Double your account on one trade? Or that's how you go broke. So we're in this thing, or I'm sitting at my desk and I'm watching the price go back up. Well, a lot of that is all these folks that are closing out their positions because they were wrong. And so you're going to get a huge retracement back down, and then the institutional traders are going to say, hey, we could have a lot of fun. We're going to sell some more dollars. We're going to buy some more pounds. We're going to pull this thing back up. We're going to make it look like it's going to keep on going, because we have to satisfy our client orders, not to pay more for our products or the dollars or whatever it is that the client is asking them to do. So they go back in. Everybody goes, oh, the rally's still on, and they go back in. Some of the institutions got caught on the wrong side of that with trades that they've been holding for a week or 3 or 4 days. They're getting caught too. Back up it goes. I go, well, this looks pretty interesting. Let's go back in. So I go back in. I get caught for a couple of $100. Okay. It comes back. I try to go back in. I get stuck for a couple of $100. Okay. Yep. It comes back down. I get in. I make $400 or $500. I get out. Price goes back up. Starts coming back down. I go back in. Make a few $100. Goes back, and it does this all over the next 2 hours. I'm in there farting around. So I came out of that first trade, $2,500 up, and I ended up for the day, right now, pushed back from the trading desk, $3,125 up for the day. So I made another $600 or $700 net overall over a 2-hour period of time when I made the $2,500 in about 10 minutes. So did I overstay my welcome? That's the question. Well, I made $600, which is, that's a lot of money. But for the risk, the added risk that I took, it probably wasn't what I should have been doing. But you get so excited, you get so wrapped up in the process, and you lose scope of the whole thing. I mean, I kept going out to the daily chart, checking things. I kept going out to the 4-hour. I'm checking the news. I'm looking at this stuff very diligently. And that's when I should have known, hey, if you're doing all this stuff, this research, you're wasting your time, because you're not going to be able to figure that out. And I should have pushed back from the table. I should have known better. right? And I didn't. And so bad on me for that. Clapped me on the back for another $600–700 in gain. But that was unnecessary risk for the amount of money that I made. In retrospect, I can say that. But even for me, this is really exciting. You get in and you see these price moves going, and you say, man, I could make a shithouse full of money. If I would have timed that trade that I made just a little bit better, instead of making $2,500, I could probably have made $4,500. But I just, in those types of volatile situations, you just don't want to press the envelope too much. And so I left $2,500 or yeah, probably $2,500 on the table that I could have had if I just wouldn't have triggered out. There was no reason, there was no signal for me in that price action for me to trigger out at that particular time, other than maybe what a normal reaction would have been or whatever. But I didn't know, and so why risk it? And I got out. Hey, Bo, come on. Under different market conditions, I probably would have held on to that. The other day I made $9,000, and that was last Friday, I think. And what was that, the 14th or something? And that's exactly what I did. I was day trading. I had a position on. I had made a couple of $3,000 in trades. I made another $3,000 or $4,000, and then lost a couple of thousand. And so I'm net about $4,000. I got into the trade. It was going in my favor. I started staging in more lots, and I'm looking down because I don't want to fall on the trail here. This is going downhill. And just kept staging lots against the position, and finally when my rule for exiting was there, boom, I'm out, and closed out the day with a $9,800 profit for the day. So I'm up. This is October, like I said, of 22. It's the 20th of the month, and I'm up, let's see, what, $29,000 for the month. I may have another $30,000 month there. It's pretty close to it. That would be my third one. These are not normal times, though. I don't pat myself on the back too much. Well, I pat myself on the back because I recognize when I can back the truck up and when I shouldn't back the truck up. And so I've been very fortunate to have a set of rules that allow me to have confidence that when I back the truck up, I'm not going to lose too badly if it goes wrong, if it goes against me, because I've got it worked out on what I can do, how far I should push it, and when I should push it. It's not very complicated. It's really pretty easy. But you just can't give a set of rules to somebody and say, oh, here's the rules, this is what you need to do. That doesn't work. It's because it's a process. I teach process-oriented trading because I trade in a process-oriented manner. And that's enabled me to have the success this year in the trading, because I've been able to gradually increase my trading lot size from 3 lots at the beginning of the year to now I'm pushing on a pretty regular basis 20 lots, 18 to 20 lots, and I've done some 25s. So when you have a large lot size and you have good discipline that you're only looking for a static number of pips, you make a lot of money, you make a lot of dollars. The danger with a lot of you guys that are in the four-figure account size and the low 5-figure account size is you're trying to make a lot of pips. You're listening to these fools. Oh, I mean, we made 100 pips today. We made 500 pips today. You didn't make 500 pips. You might have had 50 lots, and you made 10 pips a lot, and so you say you make 500 pips. You didn't make You did make 500 pips, but not the way that you're thinking about it. Oh, they made 500 pips if I had a one. It's just crazy. When you are looking at trading, you have to trade initially for the pips. And all you're trying to get, if you could get 5 pips a day, every day, that's a 0.5%, 1,000. What do you want to do? You want to make 1% on your money every day? You'd really be taking a lot of risk until you get more experience. And believe me, I mean, I think the other day, as large a size as I'm trading, I had a 3% day, had a 5% day against a large bank size. Those are rare. Most of the time, if I'm going to close out the day and I look at my trading based on the risk that I take, in other words, if I trade one full lot but I have the capability of trading 10, I'm only going to base my gain against that one lot. And so you know, I'll average about 0.8%. That's because I know what I'm doing. But if you could make 0.3% on your money every day, I mean, you'd be okay from a percentage standpoint. You know, if you had a full lot position going at $10 a lot, 3% would be $3,000, right? Or 10% would be $3,000. 1% is $300. So $150 a day is a 0.5%. You made $150 a day, you'd be making what? You know, figure it out. Yeah, it's a lot of money. And so the discipline is in trading for the pips and not the dollar amount. The dollar amount will come later. Unfortunately, if you don't have somebody to guide you, you're not going to be successful at this, because you're going to listen to all these fools out there telling you how to make more pips. Anybody that tells you how to make more pips is doing you a disservice. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.